Hello, YouTube. Last weekend, we asked whether or not the stock market party might be over. And this week, we have Captain Buzzkill, James Bullard, coming in and driving the stock market lower and creating the worst two-day drop we have seen since 2020. So this weekend, we're going to try to answer what could happen next, why does this matter, and how can we be prepared for the week ahead. Goldman Sachs is telling us that they have lowered their official S&P 500 forecast and also evaluates what a recession would do to stocks. You're probably going to notice that this weekend's video is different than last weekend's because we're now breaking out the two videos. So please go watch the one from before if you want to see all the details for the news and for key events. We're going to talk about this specific update from Goldman Sachs a little bit later in the stream. However, I want to start here. This is a head and shoulders pattern. And the reason why it matters is because it is clearly bearish. And like I said, we were sitting right near that 454, 4540 area on SPX or SPY. And we were actually all okay after that CPI number came out, which was at a 40-year high. But then James Bullard actually came out, provided some commentary, and that drove us significantly lower. And then we had some geopolitical tension with Ukraine, which drove us even further down on Friday. What does this mean? We had the potential to actually snap back, invalidate this pattern, and advance higher. Instead, we took the cue to go lower, and we are above the 50 weekly moving average, which is short-term support, but we have a clear pattern we can no longer ignore. So let's take a quick step back to understand how we got here. Me, Justin, who's who you're watching right now, has been telling you for the last few weeks that we are due for a crash. So, right, we talk about a blow off top, the Santa Claus rally. Are we going to go up or down? Stock market crash with the blood. And then we talked about potentially bouncing, the crash of 2022. In this video here, I would highly encourage you to go back and watch. It is an hour and 40 minutes, but it talks all about my bear case for next year. Then we talked about the bull trap. Yeah, looks like that was a check too. The party appears to be over. And now there is going to be a huge meeting with the Fed. And this week, it is all about the Fed. If you've not watched that video yet, highly encourage you to do that. So I'm taking a moment here just to pause to make sure people understand where we came from and where we're going. And the format of these weekend videos will change going forward to make sure that they're about 10 to 15 minutes each. And if you like the charts, if you like options, this is the video for you. If you like knowing what are the key events for the week and market moving news, that would be the video published on Saturday. All right, let's move forward. And again, if you're enjoying the video at any time, I would really appreciate a thumbs up and drop me a comment. Let me know what you think about this next week. Am I wrong again? Or is there potential we could be going down? I'm going to focus on a quote this week from Jesse Livermore. If you're not familiar with who he is a trading legend. He tells us here that no matter how much we feel that we know what is happening, we need to wait for the market to confirm our thesis. And only when it does do we make our trades. And we must do so promptly. I've been warning there might be a bear market for 2022 for, like I said, at least a few weeks, if not a few months. So now that we know we have that head and shoulders pattern, keeping that quote in mind here, let's read it one more time just to make sure it gets imprinted on our brains. Highly encourage you to pause the video if you want to read it. No matter how much we feel that we know what is happening, we need to wait for the market to confirm our thesis. And only when it does do we make our trades, and we must do so promptly. If you're not hearing what I'm telling you, this head and shoulders pattern is clear. If we lose that 50 moving average again, we are confirmed bear. It is that simple. Taking the quote here with a little bit more context. And again, this is from Investopedia. You can Google Investopedia, Jesse Livermore to find this page. I have a few areas here that are highlighted, which is where I'm going to focus. Jesse Livermore traded on his own. So if you're watching this weekend video or any video regarding the market, I would highly encourage you to take the data, synthesize it, and then make your own plan. Why only you are going to hit buy and sell. He likes trading in stocks that were moving in a trend, and he avoided ranging markets. What am I telling you? We're in a bear market. What should you be doing? Betting bear. If you're long, wait for the trend to change, wait for the patterns to invalidate, and then hop in. Where's that going to be? Higher than we are now, probably 454 SPY. When prices approach a pivotal point, he waited to see how they reacted. We lost the 200 DMA on Friday. We are hovering on the 50 weekly moving average. What does that mean? Let's see how they react. We got some early feedback, And again, if this is good enough for Jesse Livermore, maybe it's good enough for you. And again, finally, Jesse was highly successful, but also lost his fortune several times, usually when not following his own rules. So even though I was big bad bear, I closed out my big bear position a little bit early, a little bit premature. I'm now green on the year, which was one of my targets, but watching the move on Friday, even I made a miscalculation and did not hold on long enough. What did I do? I broke my rules. So if you're ending this week or and starting the year off in a really rough start, just understand that it is you against you in the stock market. And there's no one who can help you better than you. So we talked about the 200 DMA and the 50 weekly moving average for early trends. And we are going to circle back on that when we go through the charts in the last section of this video. So now let's move forward and talk about the key dates. This one here is going to be the same in both videos, the one you watched yesterday and the one you're watching today. And it's a jam-packed week. It is the Fed week. There's earnings this week, but who cares? It is all about the Fed. On Monday, the 14th, we've got the FOMC meeting. Again, that emergency one. It's not technically an emergency meeting. Yes, I wrote emergency in the title for the YouTube video. Why? That's what YouTube likes. They like nice big words that catch people's attention. Here's what I think. I think that the FOMC meeting on Monday is going to be similar to what Joe Biden did on Thursday. He was in the Situation Room, and then what did we hear on Friday? On Friday, we heard from Sullivan telling us that you should get out of the country in the Middle East if you don't want to get stuck. So met on Thursday, news on Friday. What do we have here? A closed board meeting on Monday with the FOMC, and James Bullard speaks 3 hours earlier, pre-market on CNBC. And again, he's the guy who's been moving the market. So what he says really matters. And I have one more section when we get a little bit further to address that more. US PPI comes out on Tuesday. What is PPI? Producer Price Index. It is the leading indicator for CPI, which is what we got on Thursday, which drove the market lower. So yes, this data point matters a lot. On Wednesday, we have our regular scheduled meetings, meeting minutes from the FOMC for January, where we're going to get a look back, look under the hood, and see what each individual voting member told us at that last January meeting. Also, on Wednesday, we got Fed speakers. That is going to be Thursday. We got Mr. George. We got James Bullard. I believe we got Barkin. And then, right, on Friday, we got OPEX. And then we got Williams. And then we got Waller. So what is this? It is Fed week if you're not clear. And we got options expiring. And there's a whole bunch of unknowns. So this is a jam-packed week. Every single day has important data. So if you don't really know what I'm saying yet, again, refer back to that Jesse Livermore quote where we talked about once the wheels are in motion, don't ignore them. Trade the trend. And right now, the trend is not up. So let the bulls reestablish support, let them make a new high, and then we can get back in. Why would we be bullish or bearish this week? Not a lot has changed. For the bulls, the bottom would be in, and we are pricing in peak hawkishness. What does this mean? Sell the hype, buy the news. So everyone is selling the hype that, oh my God, we're going to get 7 Fed hikes this year and we're going to start the runoff fast and blah, blah, blah. James Bullard this and Fed that, whatever. If we're at peak hawk, we should not lose that 50 EMA, especially by Friday close. Why? On a weekly closing basis, closing below the 50 EMA is very bear. It is more bearish confirmation that we're already in a head and shoulders and likely headed down. Bearish. What would cause us to be bearish? Well, nothing really. The wheels are in motion. We just have to get more of the same. That's it. Peak cycle. Already talked about this to nauseum. So again, I encourage you to watch that Bear Market 2022 Explained for more details. Finally, the other reason why we could be bearish is because there is uncertainty. There is uncertainty regarding geopolitics. There's uncertainty regarding the Fed. And what happens when people are uncertain? They hop on the sidelines. So in a bear market, when there's no liquidity, the moves can be over dramatic, which means we can go lower faster. Why? No one's making the market. No one wants to be in there putting their money to work. The surprises for this week include 3 things in order: geopolitics. Again, the 2 presidents just wrapped up a meeting on here Saturday. I don't know what's going to happen. I'm not Nostradamus. I can't predict the future. All I know is that there is potential. Next thing, which would be the biggest surprise in my opinion, is just the Fed week. It could be Monday, Wednesday, Thursday, Friday. Honestly, I have no idea. But where we close on Friday, and again, notably with that 50 weekly moving average, will really, really, really matter to me. And then finally, we got OPEX, where there's going to be motivation to push the charts one way or the other. Looking here at a 1 week chart or the heat map for the S&P 500, there's not a whole lot of green. What is it? It's what's been working year to date. Energy, aerospace and defensives, select restaurants and travel, and credit. Why? Maybe we're late cycle and we're going to go back to normal. Looking at year to date here, what's been working? Same as what's been working in the last week. Energy, a little bit of aerospace and defensive, and financials. So for me, these are the areas to pay attention to for the leaders for the next move. Fear and greed. Yes, we're in fear. Does not mean we can't go into extreme fear. What does that mean? Just because we're fearful does not mean the market's going to go higher. As you remember from when I talked about that bear market explained of 2022, we had a 600% move higher, and in the 1990s, sorry, the 1970s to 1990s, early 2000s, and that exact same thing setting up here. So what does that mean? Fear is relative. It is relative to the historic norms. And this is exactly what Bitcoin had before it plunged down to 50%. Went from fear to extreme fear, back to fear. All right, the bull catalysts. Here is where the bulls might have a sliver of hope. Why? Even I am quite impressed by the plunging the bulls were able to do this week. We talked about how there might be $10 to $20 billion in selling this last week, and I was looking for 437 or 426. Clearly, we didn't get down that far. We only closed down at about 439, 440 on Friday. So only actually getting down by 2.5% from the open, not from the high of the week, by Friday. And there was even surprises. So all things considered, we actually managed to do pretty good. So for the bulls, please listen closely. There is someone or someones out there who was willing to buy at a price that is higher than what they need to. And with no liquidity, who is it? I really don't know. I think it's the market makers. But again, my point here is that I was not expecting the flare up on Friday that we got. And we would not even have closed down in 440s unless we got that news that dropped on Fridays. What does that mean? Someone is out there. Someone's got a relentless bid, and I don't know why. So there's one sliver of hope here for the bulls. Moving forward to the bear case, this guy is cute, but he's getting a lot more aggressive. Looking forward to here again, Goldman lowers official S&P 500 forecast and also evaluates what a recession would do to stocks. So what does that mean? Well, a recession would mean a 24% peak to trough, as they usually do during economic contractions. That means the S&P would fall another 18% to the current levels of 3,600. Inflation remains. Fed hikes rate more than expected. That would decline 12% to 3,900. Inflation recedes. Fewer Fed hikes. Stocks rally 24% from here, with the S&P hitting 5,500. Drop me a comment. What do you think? 4,000s, 3,000s, 5,000s. Where are we going to be at the end of the year? Goldman has currently revised their end of year target down to 4,900 SPX. If you look at the numbers we've been talking about for the bear market cycle through 2022, a lot of them match up here. 400s, low 380s, and then 330s. So everything's kind of matching up. Our playbook is coming to fruition here. All right, we got Captain Buzzkill here. So I'm already a little bit over on time, was aiming for about 15 minutes. Captain Buzzkill. What I want to show here is that this guy is flip-flopping. And the reason why it's interesting is because when I look through here, again, this is the article which tells us here about Fed's Bullard on rate plan, possible intermeeting move. What is it? Why does it matter? Again, I'm going to type in the chair. And who is the chair? That's Jerome Powell. So what does he say here? Again, I am not concerned about the timing of these moves, and I would leave it up to the chair to manage the situation. I would defer to the chair on whether to go 25 basis points or 50 in March. All right. So what do you, blah, 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 blah. So I don't know if the chair would want to entertain something like that. And then finally, for the third time, right, the chair. I'd leave it up to the chair. So what does it seem like? This guy is just a buzzkill. It seems like he doesn't even vote yet. So his opinion is important, but when he votes, it matters more. I think what's happening here is that they're priming the pump. Jerome Powell, who is the Fed chair, like James Bullard is alluding to here, if Jerome said this or that, the market's going to move. So with James Bullard teasing it out there ahead of time, sprinkling the bear nuggets and people reacting, Jerome can see what happens to the market. Was that my desired effect? Was that too much? Was that too little? I need to dial forward or dial back, because right now it's very important. So with James Bullard speaking on Monday, what I'll be watching is whether or not he ramps up the rhetoric, meaning more bearish or more hawkish, talking about 50 basis point hike, inflation, yada, yada. And if he dials it back on Monday pre-market, what that tells me is that the message was heard, and now it is time for them to have that optionality again, from going from hawk back to dove, back to hawk. They can flip-flop. So between him talking on Thursday, him talking this Monday, the meeting happening on Monday, and then him also talking on Thursday, I will be paying particular attention to the news, but also the reaction to the news, meaning what does James Bullard say, but how do the charts react, notably by the Friday close? All right. So now we're going to go to SPY. And what we're going to look at here is the 200 DMA and the 50 weekly moving average. So let's pop over to here. And again, this is going to be the SPY SPY, which is the S&P 500. And what I'm pointing out here is just that this is a head and shoulders pattern, and we're above the 50 MA. So in my opinion, if we dance around here, we're basing on support in a bearish pattern. What does that mean? We're waiting for the confirmation. If we lose the 50, notably lose this relative low, for me, that is the start of confirmation, but it will not be confirmed until 4 o'clock on Friday when we close the candle out. So what happens here? Inside bar, indecision. That's what an inside bar literally means. If we stay within this range of roughly 439 to 458, that's a 20-point range. If we stay within that range, indecision. We're selling the news, selling the hype, and then potentially buying the news. If we break bear here, this is a bearish engulfing candle, and falling below the 50 is bearish. So like Jesse Livermore said, if we lose the 50 and it's holding into Friday, believe your eyes. Believe your eyes. Please believe your eyes. And then looking here at the one-day chart. Now, again, same pattern. We've fallen below the 200 daily moving average for the first time here. Last time that happened was back here, and that was in late January. However, historically, when we close 2 days below, what do? We stay below until we get multiple closes back above that range. So let's look back in time. Let's see what happens when we close below the 200-day moving average for 2 consecutive days. Oh my gosh. Here's the last time it happened, right? Well, ooh, that's not so good, right? Closes below for 2 days, dead cat bounce of the trap. Technically closes 1 day above, 1 day below, 1 day back above. 2 days below, there's the plunge. So again, when it closes consecutive days below, that's usually the warning sign we're going lower, like it did here in the 50 MA. Let's check back for one more time period here. Here we go, right? 2 days below, trap. Here we go, 2 days below and drop. That's 2018 when Jerome surprised the markets in late December of 2018. 2 days below, there's your drop. So to summarize it simply, that is the 200 DMA and the 50 weekly moving average. Now let's move forward to the S&P on some weekly timeframes here. Here's a monthly chart which shows a head and shoulders pattern. So losing 438 means we go down to 428. How we invalidate this pattern is by getting back above 458, which would be a weekly higher high. If we stall out here, the weekly chart already tells us that we stopped going up. We are going down. All we got to do is lose the green line or the 50 weekly moving average. That is it. Then we're going back down to test those January lows at low 420s. On the daily chart, here we can note that this pennant goes back a while. We got this blue uptrend here, which goes all the way back to April. We're resting right on it here. We cannot afford to go down more. We have to snap back and get back above the 200 DMA. Into Friday is where we have this apex to hold that 442 area. And then looking here on our hourly chart, which is where we see that same apex here. So we got a big, massive apex. We got a test here going into the close on Monday, just after that FOMC meeting. And then we have a Friday test over here for 445. What is that? That's our 200 DMA. Moving forward here to QQ. Actually, let's look at the chart here. Let's just make sure. There we go, ETFs. Moving forward, I am choosing select ETFs, and drop me a comment below if you want me to do the specific ones for you. I'm going to focus on QQQ, XLF, XLV, IWM, and DIA, and maybe I'll also do ARK. All right, QQQ. Here again, we note that we got a monthly pattern, which is a head and shoulders. That's bearish, by the way. Losing the 337 area is confirmation. Moving forward here to our weekly chart, I am noticing a funnel lower, signified by the blue lines. After we stopped going up, now we are going down. What is that? That is a trend change. The trend is down. We're below the average. All we got to do is confirm it. XLF is bullish. And when XLF is bullish, that is usually bearish for QQQ. Why? Higher rate environment is good for stocks. It is bad for growth. Bullish. XLV rejecting off its upper uptrend, fully engulfing the bar, closing out the low of the week, still above the 50. Nothing here that is terrible, but a bad omen. Looking at IWM, this is trash until proven otherwise. The stock stinks. It's stuck in a range and went sideways for a very long. So it went up. So it went up. It went sideways. Now it's going down. Hopefully you see the pattern. The green line is down at 170, which is strong support on the 200 weekly moving average. So again, we go up, we go sideways, then we go down. Tell me this thing's not going down. Finally, let's have a look at ARK. Oh, actually, DIA than ARK. The Dow was going up, started going sideways, also going down, closing slightly below that 50 moving average. Just a few cents below. And then ARK for growth. We can note here that we're stuck in a downtrend. Again, went up, went sideways, went down, and has not stopped going down. We got higher highs and higher lows for 2 weeks in a row. However, closing back below the 200 weekly moving average is bearish. I don't like this chart at all. Looks like it's going to fade into here and then drop below 65 for that ultimate test I was looking for, down to about 40 to 50. Fully puked the whole move up for a massive M. All right, that is ETFs. Moving forward to options. And this is the final segment of the video. I'm pulling forward one options chain, which is the most important one for me. This is going to be the SPY February 18th, 2022 monthly expiry, which is going to be this next Friday. What we're looking at here is going to be the 16s, which means 8 strikes above, 8 strikes below. And we can note here that we got activity at 448, 445, 440, 435. And there is volume and open interest. If the open interest decreases, that's a little bit bullish. If it increases, that is bearish. And important to look beyond the 16. So we're looking at the bear flow beyond the 16s. Here we're looking at 430, 425, 420, 415, all the way down to 400. Again, the reason why this matters is because these are finally flipping back to green. We can see that they got pretty sizable green moves on the day, some up nearly 100%. If this is salvaging, that OI will decrease dramatically. And if this is bearish, we're going to see those numbers get higher, if not around the same. So we're going to use this as a moment in time to circle back and have a look on Monday. With that said, this is now the end of the video. And I just want to make sure everything is crystal clear here after you watched everything that I presented. We are in a head and shoulders pattern. All we need to do is lose the 50 MA. We're already below the 200 DMA. Going below the 50 would signify we are into a bear market. And we're looking for much more downside from there. Probably at least 4,000, if not down to high 380s. Before we get a decision on where we're going to go from there. Thank you again for watching. I encourage you to smash a thumbs up, subscribe to the channel, and drop me a comment if you like what you're hearing. We're also going to be uploading videos to this channel regularly starting on Monday. Another reason to subscribe. Thank you again for watching. We will see you on the next video.